Welcome back, Daniel Brereton from Equity Multiple. I'm our Director of Investor Relations. Today we're going to be discussing the Greater Orlando Small Bay Industrial Facility. It is a fully occupied 17-tenant industrial facility just in Kissimmee, Florida. That's just outside of Orlando. Ultimate Realty is the sponsor. Today I'm joined by Michael Saba, co-founder of Ultimate Realty. Welcome, Michael.
Thanks for having us. We're excited to be here.
And Mark Savak, also co-founder of Ultimate Realty. Welcome, Mark.
Thank you. Pleasure.
So now, as a four-time repeat sponsor, we really appreciate the partnership with Ultimate Realty over the last few years. For those that have not heard the story before, Michael, could you walk through what Ultimate Realty is, what you guys look for, and how the company was founded?
Yeah, sure. So company's been around for just over 35 years, predominantly focused on value-add opportunities on existing buildings. So adaptive reuse has always been our strong suit. We reimagine buildings and make sure that we can achieve full potential from the existing bones of these assets. We are a 8-person shop, so we're a lean team, and we are a middle market player, I would say. So adaptive reuse, all value-add opportunities, and we're sourcing excellent transactions that will yield our investors the adequate risk-return profile and risk-adjusted returns.
Yeah, as a four-time repeat sponsor, we've had a lot of success. So can you maybe give an update and history about the transactions that you've Equity Multiple and Ultimate have worked on together?
Sure. So the first asset we bought was an industrial facility in South Windsor, Connecticut. It was about 256,000 feet. When we acquired the asset, we noticed that the tenants were paying well below market and all on short-term leases. We quickly went into the building and after acquisition and turned all the leases to long-term leases and mark-to-market the rents. And we quickly refinanced and recapitalized the deal. I believe Equity Multiple made a 52 IRR in the deal, which was a great return. And then we went on to acquire an asset in Orlando in the Creative Arts District, 55,000 square feet. It was a sale leaseback with one tenant paying well below market. That tenant has indicated that they plan to extend their lease at market rent, which will happen hopefully in the next year or two. And in addition, we renewed the other tenant in that building on a longer term basis. So that seems to be going well also. Lastly, we purchased a 3-building portfolio in Pinellas and Tampa, occupied by Pods. That transaction closed in December. That was a $21 million transaction, of which Equity Multiple provided $6 million of equity. The tenant is currently paying about $1 million in a rent across the 3 different properties, and we believe that rental figure today is about $1.5 million. So in just under 2 years, when the lease expire, we plan to mark-to-market those rents and then exit. And in addition, we are in active negotiations with a tenant, so we believe that we will hit our business plan a little bit early and secure some term with the existing tenant. So this will be our 4th deal, and we're excited.
And Mike, I'd love to just jump in and add to some of your great thoughts. One of the common themes just between these 3 deals, and hopefully to be 4th, and it's not the only thing that we always look for, but it just happens to be a common theme, is that all of these buildings, starting with the Connecticut with all the month-to-month leases, as well as the building we bought in Orlando, in the Creative Arts District, as well as the Tampa deal with Pods, they all had short leases. So while it's not something we always cater to and always target, one of the interesting things about short leases is that they're difficult to finance. So when they're difficult to finance, it makes it a little bit more competitive for other buyers to step in. But we have a great team that puts together the financing for these transactions, which allows us to be competitive. And again, another theme between all these buildings that they're always below market rents. So, I think Michael and I and our team have shown, strong resiliency to mark these rents, create the upside, sign longer-term leases. With longer-term leases, it really allows us to take out much better financing, makes the buildings and the assets more financeable, which creates value. So again, on John Fitch, they were all month to month. The building in Orlando in the Creative Arts District had a year and a half, 2 years of WALT, and the same thing in pods. And again, the same thing here on this upcoming transaction with about 1 year of WALT. So short-term leases, below market rents, similar story. We do our homework to understand what the market rents are, get in there, and thereafter look to refinance or exit on all these various transactions.
Great, great overview there. And, it seems to be building a lot of experience, not just in this transaction type, but in this market, right? Third time property in Florida with equity multiple. You seem to have experience in the location. So what about this region is attractive, both for your strategy and this type of facility?
So I would say we're more focused here on this specific transaction on the physical aspects of the building, not so much on the access to major, highway arteries and thoroughfares, because we're not looking at a distribution facility. We're not trying to understand how long it'll take to get to the closest, to the I-4 or major highways, because it's just not a distribution facility. It's not a 3PL that's going to take this. This is more of a business park. These are smaller tenants. These are tenants that need small amount of office. They need an outpost, and they're in the field all day. They're not trying to, hit major population centers and make sure that they can be delivering packages to, local residences in a matter of no time. So going back to the location, in terms of growth in the greater Orlando market, we're seeing a lot of a big push to the southwest region, Kissimmee, Lakeland, Haines City, really because there's no land to develop, and that's kind of that thoroughfare that connects Tampa to Orlando, and there's a lot of development going on there. The issue with this building, or this type of building, it's just that it's not feasible to build given where construction costs are today and where land prices are. So that's another reason why we like the building is really because of the basis. But in terms of the region, we're not as sensitive to highway access given our tenancy here.
Got you. Yeah, and before we get too deep into the business plan, how did you acquire the building? How was it? Was it a private buyer? How did you come across this asset?
Sure. So I can give you some backstory on the seller. The ownership group is a handful of Australians that do not live in Florida. They do not live in the States. They actually set up a management office based in Atlanta to manage this asset, and the leasing broker is actually based in Fort Myers. So no on-site leasing, no on-site property management. We're under the belief, in our market comparables will prove it out, that this is being leased well under market because of the lack of ownership and the ownership that's just not hands-on.
I'd like to add one thing in there, Michael. Sorry to cut you off. Where we like to think this particular seller as hands-off as it relates to leasing at market rents, but hands-on as it relates to taking care of the asset. The asset is in tip-top shape, Class A asset as it relates to this type of product in small bay. If there's a leak, an occupancy is always full. So I think their strategy is a little bit more to keep the space full. They bought it a while ago. They leased spaces here. They're making money. They make a profit. But
in the Islamic religion,
and I don't think they have the infrastructure to really support that type of agenda.
as a lady, you should not show your back like a these are the law. Everyone wants not for the year 2019 or 2020.
But they run a very clean shop, very clean books. The assets,
like
I said, excellent condition. If there's ever a leak, it's fixed within days. That's what
all
we've learned
of
so
them
far.
from everywhere now fighting this girl. Then the same year, I mean next year.
No, one last thing I was going to say just about the asset.
About
7,000 square feet of one of the buildings was leased to an automotive company that was taking old Land Rover Defenders and fixing them up and then selling them and putting all new parts in them for custom automobiles. That tenant actually took space across the street because they were outgrowing the space. So what the ownership did was they took it back and then leased it out to 5 different tenants and put in partitions and office space and all of that, which is a big positive for the asset now because we wouldn't have to incur the cost to put up any drywall partitions or office space or HVAC. So we get the benefit of that. That happened about 12 months ago.
Yeah, and you've mentioned previously in previous conversations about opportunities we've discussed, you look at replacement costs when it comes to what type of building you're looking at, the basis that you can get at. Is that a factor in what make this property attractive to you, and what else is making it attractive?
Yeah, so there are a handful of things that are making this asset class, or this very easy to backfill those tenants. We ran comps on a couple of these different parks, ranging from 50,000 feet to 100,000 square feet, and there's virtually no vacancy. Whenever there's a vacancy, there are 4 or 5 tenants to backfill them. That's according to 2 different brokers that do leasing on comparable sites. The nature of this small bay asset class is that leases are shorter term. So you have the ability to mark the rents every 2 or 3 years. Instead of locking in a 10-year lease where you're fixed at 3 or 4% annual increases, and the market rents could go up, 7, 10, 15%, like you've seen in Orlando. In addition, it's, like I said, expensive to build this. You need to build office space, you need to put HVAC in for that office, you need to put up drywall partitions, and a handful of roll-up doors. It's not like building a 500,000 square foot box that's just open. So that makes the barrier for entry a little bit higher. Today, where land prices are, construction costs are, this can easily cost $150, $160 a foot, which I'm not sure makes so much sense to build on a speculative basis. And in addition, it's hard to build this on a speculative basis because you don't know if a tenant's going to need 800 square feet or 2,000 square feet. So buying this building in an existing condition, which is in excellent shape, we thought was a great opportunity, especially at $117 an existing foot, well below replacement costs.
Excellent. Yeah. Obviously,
Daniel, I'm just going to add one thing in there as well. Just as relates to all things new construction. So, as it relates to industrial new construction, typically you'll see developers just move in waves. The wave today is to build big bulk industrial buildings that are catered to 3PLs and last mile logistics. The wave is not to build small bay industrial. We're looking across the country, specifically in Florida, but we're just not seeing a lot of new construction builds for these smaller small bay facilities. Number one, it's a little bit more difficult to manage, a little more tedious, and it's just a lot easier to just go build million square feet, get one tenant and put it away. Additionally, the cost is obviously substantially more higher. Cost our tenants as opposed to one tenant. So the trend today is to build larger bulk facilities. So even as construction continues in this constrained market, we don't think it's rebuilding these small bay facilities. So in terms of competition, we think it's everybody that we know who we have today.
Yeah, and if we look at the capital sources and who's investing in this arena, especially in Florida and across the Southeast, it's large private equity shops, it's larger institutions that need that 500,000 footer or million footer to deploy a certain amount of capital, right? Someone wants to write a $20, $50 million equity check, they probably can't achieve that buying these smaller bay buildings. And these larger institutions are really driven by credit. So they want to see Amazon credit, they want to get Walmart, where they can have that institutional grade product. This is not, for better or for worse, it's not institutional type credit. These are mom and pop businesses. These are businesses that really can't go anywhere else. they can't sign for 20, 50,000 square feet. They don't need it. They're pretty much outgrowing, their garage, and they need somewhere to go.
Yeah. Obviously, it seems, risks, but also advantages to having those multiple tenants. But attractive property. Maybe Mark, you can go into why this is a great candidate for your business plan and how you're going to apply that on this type of asset.
Sure. Overall, we own a few different types of industrial real estate. We own manufacturing buildings, last mile logistic buildings, 3PL. We have a lot of different types of tenants. Just in general, we listen to the market. Very hands-on as it relates to just broker discussions, etc. This small bay asset class we consider really like the multifamily of industrial. Industrial is typically, larger size units, larger size tenants. We like the ability to keep occupancy high. So this is an asset class that we've been looking at for a while. Most of the small bay facility assets in general, just nationwide, are really owned by mom and pop owners. And many times they're really like retirement projects. Someone buys a 17-unit industrial building and they'll buy it, all cash, or they'll go get bank financing and they'll just operate it as a hobby. You really don't see it owned by institutions unless it's on a much larger scale or unless it's a much larger portfolio. With that being said, we've really seen these types of assets trade at much higher bases, as well as much more compressed cap rates. So we have been studying the market for a while, and we just haven't seen anything that was this attractive, both on the basis and the in-place yield, as well as the mark-to-market opportunity. So as soon as we saw it, we really jumped in. This will be our first small bay facility. It's definitely a little bit more management intensive, but we really like the fact that the seller had really clean books. All the tenants are triple net. This allowed us to really step into, well, I wouldn't call it a new asset class. It would be an
extension of what we own.
Maybe it's an extension of what we own. And, we're excited about that. We think it's an easy transition from old ownership to new. And, we're super excited about that.
Yeah. And, we've talked about this multi-tenant aspect, and I mentioned before it's 17 tenants currently fully leased up. But that obviously spreads the credit risk around to those 17 tenants, but there's potential for turnover with some of these shorter-term leases. We saw in our underwriting that some of the tenants have a couple leases coming up pretty soon. What's the wait list look like, and what does it look like for you to fill those or backfill those leases?
So from all the homework that we've done and all the different data points that we studied, we can't hear it enough. It's almost comical, but for every single space that ranges within 1,000, 2,000 square feet, there's usually 3 or 4 people on a waiting list. In terms of the comparables that we've looked at, we analyzed the deal and we put in 3 months or 2 months, I believe, of downtime in between one tenant and another. A little bit more conservative, but we're super comfortable with the occupancy staying high. And overall, our thesis here is to put longer-term leases on them, contrary to what the previous owner was doing, which was 1-year leases for the most part with not that many renewals. Only a couple tenants actually have renewals. We'd look to sign probably closer to 5-year leases and just put it away. Maybe that'll cap our upside in the future as inflation continues to exceed what market increases are at 3-4%. But we think that it makes the asset a little bit more financeable, and also helps our ability to exit for the next buyer to be able to put financing on that. So that's the way we look to do it.
Yeah, and just going back to the rollover here, we're actually in touch with the leasing broker that's based out of Fort Myers that was doing the leasing for this building, and she echoed the same thing as 2 other brokers that had mentioned that there are several tenants that are almost on waiting lists for some of these industrial parks to backfill the next space. We have, as Mark mentioned, I think 60 days of downtime between the 2 different tenants. But the reality is it's usually a couple of days, maybe a week, until the space is painted. In terms of the TIs that go into these spaces to get them ready, it's generally just a fresh coat of paint, and you hand the keys to the next tenant. which is also great. So if there is any rollover, it's not an office space, it's not building a new office. It's literally just giving it to the next tenant with a fresh coat of paint and maybe some new carpet down in the office.
That's great. Yeah, and it sounds like it's a pretty well-structured transaction. Obviously, in this market, with interest rates rising, investors are keen on how the transaction is being financed. So, how is the capital structure looking on this investment? With equity multiple investors.
Sure, I could take this one. Overall, I think we're all aware of everything happening in the capital markets. We're obviously keen to it as well. So with that, when we originally went into the deal, we said, hey, let's take sub 50% leverage. Let's have 2.0 DSCR in place. Let's get fixed rate debt. So those are some of the things that we did. So again, we have fixed rate debt here, sub 50% leverage. Our goal is to mark to market all the leases and then sell the asset or refinance thereafter. The deal is accretive enough that we don't need to put on 70, 75% of debt. So we're excited about that. And I believe it's an 88-12 split in terms of equity multiple and Ultimate Realty's GPLP equity position.
Yeah, and we'll have positive cash flow day one, obviously.
Yep.
Which is probably great to the equity multiple investors.
Yeah, definitely. Obviously, you guys are strongly aligned. Over 10% of equity contributed really puts you in the same shoes of us. And that cash flow is very attractive, especially in this market where, as you mentioned, the capital markets are all over the place. So having some cash flow along the way, along with such a buttoned-up business plan from y'all, I think it's a very attractive prospect. But, on the risk side, we always have to acknowledge that, like in any investment, there's risks. Where do you guys see that this can go wrong, and where do you guys think that we can mitigate those risks?
So where I think there are potential risks are really a pullback and a slowdown in both the construction and hospitality industries in Orlando. Obviously, we know that Disney is a main driver in Kissimmee and in Greater Orlando, and there are a lot of businesses that need to service those parks, and some of those businesses are within our facility. So the construction industry as well. If there's a slowdown on multifamily housing or industrial facilities and whatnot, that could also potentially impact some of our existing tenants. Now, how we mitigate those is marketing efforts with our leasing broker, different data points, and being in the know in Orlando, who's looking for space, what tenants can backfill potential businesses that may go out in our facility. But overall, we do see or we have seen an influx of different businesses over the past year or two that came down to Florida from the Northeast and all different cities that just need space. They need an outpost, they need to operate, they need a small amount of office, and that's why we do have waiting lists on a lot of these buildings for tenants that need to occupy space. So we'll pay really close attention to different tenants that are in the market and also be really in tune with the businesses that are operating out of our facility and see where there is exposure based on macroeconomic factors.
Yeah, like we've seen in other research that Equity Multiple has done, and I'm sure that y'all have seen on your side, there's just a recent report of some of the fastest growing job markets, and tourism-focused markets are actually seeing a lot of net gaining of employment, which I think is an early leading signal of pickup in tourism and hospitality in these markets, which obviously supports your thesis there.
Yep. I think Orlando, and I had it somewhere on my screen, was the second or third highest job market in the country. It went from, I think, maybe 15 to the third in a matter of 2 years, which was pretty interesting to see.
Yeah, and Daniel, also to your point, I mean, all things capital markets. I mean, we're buying a fully occupied building with cash flow on day one, below market rents, in down economies, we look to buy occupied assets with positive leverage. So, even if there is a downturn, we think that we could weather it. That's just the reality.
That's great. Really great color from both of you. If there's anything else that you guys think, an investor should know or that we missed on our call, Michael, any other last thoughts for our investors?
Not in particular. I would just say, this is going to be the first of, a handful of transactions, hopefully, that we buy within this asset class. So a potential exit strategy could be to acquire a handful of them where it's sizable enough for a large, institutional investor to take down $50 or $100 million worth of this product and compress that cap rate maybe 50 or 100 bips. So that can certainly add to the value of this transaction and a handful of other future ones.
All right, Mark, any final thoughts from you?
No, I think we really covered it. I really do think we covered it. I mean, it's a very simple deal. We don't think this is one of those complicated deals, which we've definitely been experienced to and have done. Again, fully occupied, cash flow on day one, below sub 50% LTV. Those to us are attractive. If the deal was tight, maybe we take on more debt, but we're not.
One thing that I'd like to mention, and I don't think we covered, investors may be looking at this deal and saying, oh, they're paying $8 a foot now. How are they going to get $13 a foot? That's a big jump. And it is a big jump. When we look at the rents, what we're comfortable what we're comfortable about is that we're talking about 1,000 square feet. We're talking about 1,500 square feet. It's not that big of a jump in the scheme of things in terms of total dollars. So maybe a few $100s a month that a business is going to have to pay, in addition when we mark to market these leases. But some of the businesses that we've seen, that we met with, we think they're doing, hundreds of thousands of dollars in sales, and can certainly afford another $300, $500, $600 a month in rent because there's nowhere to go, and their businesses could afford it. So we're pretty comfortable there.
Excellent. Yeah. And especially you mentioned about, a difference between occupancy focus versus cash flow focus. If you find that economic sticking point between a solid enough occupancy, but at the right market rents, you can actually increase the value of this property, my understanding.
Yeah. And Daniel, our strategy here is not to go sit down with every tenant and say, hey, we want more money.
Yeah.
Our strategy is to lease the space, put it out for a lease as the leases roll, bring in a new tenant, and the existing tenant could either talk to us or not, but we're not going to go knock on doors and ask for more money. That's
and we assume that we would turn over more than half the building, which is probably highly unlikely. So we're probably over budget on leasing commissions and downtime. In my opinion, the majority of the tenants will stay. We actually spoke with two of the different tenants when we toured the facility with Equity Multiple, and I remember one of them told us specifically that they were told by a friend, just take what you can get and don't give it up. So someone showed us their cards a little early in the game, and we know what that tenant is. So.
Yeah, nobody wants to move, and we don't want to have uncomfortable conversations just in general, but we're going to put it out to lease with a seasoned broker who we like a lot, and we're excited about it. And we don't think there's going to be much pushback either on the mark-to-market rents, because if they look to move, they're going to see similar rent figures throughout the market. So
that's great. Yeah, really appreciate both of you, Michael, Mark, for joining me today. It seems like you really did your homework there, and a really well curated deal. We're really happy to have you guys back for a fourth time. Hopefully investors find it as compelling as I did. But once again, I'm Daniel Brereton, our Director of Investor Relations here. If you have any questions, you can always reach us at